Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching another episode. I greatly appreciate all the comments and the subscribers. Please let me know what stocks you're interested in seeing. I'll try to get them done. And then comment, let me know your feedback on the analysis. And always, please subscribe. All right, today we're going to look at AMD, Advanced Micro Devices. We released Intel earlier. This is going to be AMD. I'm going to follow with NVIDIA. A couple bits of information on AMD. So I've gone through their 10K and read it. I highly advise everyone to go read it. And the one thing that struck me most apparent when I read it is that they have monster disclosure in here of Intel specifically. And I thought that was really interesting that they're saying essentially, let me quote this. Intel Corporation has been the market share leader in microprocessors for many years. These aggressive activities have in the past resulted in lower unit sales and lower average selling price for many of our products and adversely affect our margins and profitability. That's remarkable. I mean, I've seen a lot of disclosures in my day, but they are basically saying that Intel is dominant, and Intel moves the market in a way that AMD can't. And when you think about positioning of a business, if you're going to buy into a company, you don't want to buy into a company that is pushed around by another. So I think right off the bat, I'm looking at that as a big red flag that Intel is so dominant, AMD is going to be hard for them to compete. So if it's going to be hard for them to compete, their numbers better be stellar and they better be super cheap for us to invest in it. Okay. Let's go over some quick guidelines. I'd like to remind everyone again, this channel is value oriented. We are looking for the intrinsic value of a stock. We try to find that by 5 key attributes. We look for top line revenue growth. We look for earnings growth as defined by EBITDA, a solid balance sheet, positive free cash flow, and a well-priced security. All right, let's dive into Advanced Micro Devices and check it out. Behind me is a decade of revenue from them. And what you'll notice right off the bat is revenue is flat for the whole decade, 0%. So even Intel had, Intel had what, 3% growth if I remember, which was decent, kind of slightly above inflation. But these guys couldn't even manage any growth, which is surprising. Their recent 2019 year did have higher revenue, but when you dig into it, higher revenue was because they pushed higher pricing through, not because they're moving more units. And I always like to see volume move, less so than the pricing when I'm looking at revenue growth. So I think revenue for us doesn't check the box. They started at $6.5 billion, they ended at $6.7 billion. That doesn't really move the needle. Let's go through our EBITDA calculation. Again, starting at earnings, add depreciation, we get our EBITDA. EBITDA here has grown, if you take the beginning value and the ending value, but it whipsaws all over the place during the decade, and that makes it incredibly difficult to forecast going forward. And what we're trying to do is come up with a forecast we can believe in. And how can I believe in any of these numbers if revenue's flat and earnings is up and down? What are we supposed to do with that? All right. So you look at these numbers. Yes, technically the average is 161% minus, but I wouldn't use that number. Okay. And what we're going to do is we're going to use these forwards for the sake of an argument. We're going to use the most recent 3 years and kind of pull it forward. And that's actually a healthy growth rate. 300 million to 900 million in 2 years of growth is a healthy growth rate. So just for the sake of an argument, we're going to pick that growth rate up, string it out, and see what that looks like, even though I don't believe this fits our criteria. Let's keep going and look at enterprise value. Enterprise value begins with debt. We're going to pick up all the short-term, long-term debt, any pension liabilities or other obligations like lease obligations that they might have, right? Market cap, that's shares outstanding times price. Add it all up, you get enterprise value. Enterprise value has gone from $6 billion to $50 billion. Interesting. Debt has gone from 2 to 1, so debt's come down. Enterprise value has almost gone up tenfold. But wait a second, we've got flat revenue, earnings which are all over the place, recently growth, but really all over the place. Debt's declining. Why is the enterprise value going up fivefold? Well, you can see it right here. This really tells you the story. This is the enterprise value divided by EBITDA, or the multiple that it trades at. On average, AMD has traded 18 times earnings, and most recently, at least the end of the fiscal year, it's at 51 times earnings. Now that is astronomically high. If you remember Intel traded 7.7 times. This is at 51. For a company that's not growing top-line revenue, that has earnings that are all over the place and negative on a 10-year, up recently, but I still don't think that smell checks me. Why would you pay 51 times EBITDA for this company? That doesn't foot. And then on the debt side, the debt looks decent, right? 1 times EBITDA is low debt. They don't have excess cash, but at least their debt's in the right place. So if we think of our 5 key attributes, right, we've got top line revenue growth, which is 0, doesn't happen. Earnings growth didn't happen. Now for the decade, recently, yes. Well priced, no. 51 times is way too expensive. You want something that's less than 20, even for growth stocks. I want less than 20. Remember, I want to direct you back to the IPO, Google IPO versus Domino's stock. Right, Domino's went public at roughly 7 times. Google went public at roughly 22 times. Google still performed well because their growth was astronomical. But Domino's beat them. Why? Because they went out at such a cheap price. When you buy something that expensive, you really curtail your growth opportunity. Let's go look at cash flow. Cash flow is kind of the same story here. Cash flow from operations, 3% growth, and it's all over the place, positive and negative throughout the time. CapEx is kind of small relative to 19's cash flow from operation, but in general, they don't seem to be able to afford the CapEx they're investing, right? They're paying down debt, which we saw, but as a result of the low free cash flow from operations, the high CapEx, free cash flow is negative. So free cash flow per share isn't doing it. And if you're intrinsically valuing a company based on cash flow, you can't really assign a value here. That means you're gambling, right? And we don't gamble, we invest, right? First rule of investing, don't lose your principal. Second rule of investing, don't forget the first rule. So this one I think is a problem for us, and I really can't explain why the share price has gone up continuously. I think people are gambling. It could be froth in the market in general, and I think it's really important you start looking at single stocks and not betting on the index like many people do. This is in the S&P 500. When you buy the SPY, you automatically put money in this, and you're buying a stock that, in my opinion, is overpriced. Okay, so now we've gone through free cash flow. We know it doesn't, free cash flow is negative, revenue's flat, earnings are flat, debt is good, but it's overpriced. So that's 5, it's really only meeting one of the 5 key attributes that we look for. Let's go ahead and forecast it just to show you what this would look like if it does pan out. All right, let's forecast the stock price for AMD. Behind me is the EBITDA and its growth rate. Now I've given it a 25% growth rate. Why? Recently they have grown. I don't want to discount. The last 3 years they've grown EBITDA nicely. But it still doesn't meet our hallmark of a decade, right? This could be a blip. So for us investing, I think it's a pass, but I want to show you what the investment return looks like even with solid growth, and how the effect of a high multiple now, buying it, affects the growth rate. Affects the return. So here's our EBITDA, 1.1 billion goes to 2.3 billion, it doubles, right? I'm giving it a market multiple of 18%, 18 times, which is the average. So what's gonna happen is you're gonna buy in at 51 times, and that's gonna come down to the average of 18 times, and that's really gonna restrict the return. That means my long-term forecast here is $28 a share. Let's look at free cash flow. Free cash flow is 12. Now, I told you earlier that free cash flow was negative. So what I've done here is I've looked at most recent year, and I put aside the debt for a second and just looked at the cash flow from operations minus the CapEx to see what they could potentially get if they could fix the financing and kind of clean things up. It seems like they're almost there, but I gave them the benefit of the doubt. Forecast that forward at a very aggressive growth rate, I get a $5 per share price. So we got $5 and we've got, what I say, $28. $28. If we go over and take a look at the economic return, so what we're going to do is we're going to take the difference between, or split the difference. You have $5, you have $28. We're going to forecast a $16 share price for AMD in 2029. Now, if I plug that into an IRR calculation, right, it's currently priced at $23. Here's your $23. Our forecast price is only $16. And even then, it is giving a strong growth rate where we have not seen evidence of a strong growth rate. And it's assuming that this 51 multiple that they have is too high and will come back down. So I think this is a losing investment over the long term. I just can't see the stock price going any higher. It's already trading at 51 times. So what we're going to do is we're going to pass. We're going to give this actually an ugly. I think it's way overpriced. And if you get in, you risk losing a lot if this market takes a correction, or if people start selling out of the index, they're going to indiscriminately sell this as well. Let me know your feedback. Let me know what you think. Thank you very much for watching. My name is Cameron Stewart, CFA. This has been Rational Investing. Thank you for your time. Bye-bye.